Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. And it's a bit of a mixed morning so far, particularly for European equities, after a miserable German manufacturing PMI reading dropping to 38.8 and signs of weakness in demand there, really knocking back European equities, dragging the FTSE 100 with it. Overnight, you did actually have quite a positive performance from Asian markets, hitting a 16-month high overall, with the Nikkei putting in another strong performance there. It looks like that index is beginning to recover over the medium term as well. The RBA, of course, Reserve Bank of Australia, holding rates unchanged once again, of course, leaving the door open for rate hikes later in the year if inflation does pick up. But for the moment, that central bank is on pause. So as I say, we've seen a slightly weaker morning in European equities. Not that many companies reporting, although we have had BP numbers this morning, which of course has reflected the big downturn in oil prices over the past year, although they've now rallied from the June lows, which is giving some hope for the oil sector. Without putting a bit of pressure on the FTSE 100 so far as well. So that's an interesting one to watch, following on from Shell's numbers last week. Really, the oil sector really taking it on the chin at the moment. Of course, it's back to earnings season as well today after Monday's hiatus, so that's one thing worth watching out for in what is otherwise slightly quieter afternoon, just as Chicago PMI on the economic calendar. But we've got earnings from Caterpillar, AMD, Starbucks, Uber, Merck, Pfizer, all on the list for today in the US earnings season, really coming back with a vengeance. Starting with the indices, beginning with FTSE 100, currently trading at 76.67. And you can see here how the index has stalled over the past week, really, as it got back to 7,700. Now, in one sense, this isn't particularly surprising. We saw the index rally sharply from the end of July and really given further impetus by that weaker CPI reading in the US markets, cheering the fact that prices only went up by, 7.8% over the course of the past year, rather than the 8% or more that had been expected. So that saw the index gain around about 350 points or so from its July low, and it's finally started to see a bit of indecision creeping back in again. Nonetheless, as you can see here, the price action over the past 2 or 3 weeks has put it back above the 50, the 200 and the 100-day moving averages in that order. You have had, of course, the death cross, as everyone likes to call it, in the moving averages, 50-day moving average crossing below the 200-day. That's very much reflection, of course, of where we were in February, where we are now. So that downturn in the 50-day, somewhat a backward-looking indicator, of course. It's just not really surprising, I think, just to see the index consolidating around 7,700 and that kind of area, really, after the strong gains we saw from the end of July. Admittedly, of course, that was the lowest level in the beginning of July since the middle of March and the banking crisis. So it has been a very mixed performance of FTSE 100 over the course of the year so far. Of that strong start, things really have deteriorated. But I think if you saw a daily close back above 7,700, that certainly would give fresh impetus to the index and take us on then towards 7,800, which was where we saw some resistance develop during the course of the first half of May, and then on really to 79.30 and the April high, and beyond that takes us on actually back to the record high of early March, up at 79.75. Still, not zooming far enough. February's high, 8,044. Sorry, we did get to 8,000, of course, at the beginning of the year. Not such a great performance since then, of course. On the downside, selling has been relatively contained around about 76.30. So in the short term, this is our zone that we're looking at: 7,700 on the up, 76.30 on the downside. Back below that, and maybe a more bearish view begins to prevail, particularly if we then also see the index dropping back below the 200-day and below 75.60. Turning to the DAX, and as I say, European markets under pressure this morning because of that shockingly weak German manufacturing PMI down to 38.8, quite the reversal there, signs of weakness in the German economy. And that comes just a day after a new record high, intraday high for the index, up at 16,532. Now, you have to note the fact that we actually have what's called negative divergence in daily stochastics here, because here's your previous high in stochastics, and while the price has rallied, the stochastic has actually fallen to a lower high. So technical analysts call that negative divergence. It can be seen as a rather negative indicator, at least in the short term. And you could argue duly the price has delivered the 1% fall this morning back towards 16,300. So we're watching out for that. Although it has to be, again, to put in context, back at the beginning of the month, we were about 1,000 points lower than we were as of Monday. So perhaps we're just seeing a bit of weakness creeping back in again, the consolidation. It wouldn't be perhaps too unnerved by it unless the index goes back below 16,000, and that brings 15,700 into play once again as potential support, with also just below it, because there's always another line to watch in technical analysis around this 15,500 area, which was the low in July, and also provided some support during the course of April. So we're watching that for the moment as the DAX just weakens after its latest record intraday high. Moving over to the Dow, no particular signs of weakness here, of course, just the future slightly indecisive ahead of really the bulk of the earnings this week, today, tomorrow and Thursday, really when earnings season moves into focus once more. You've got Apple and Amazon to watch out for. So while it's not such a big weighting in the Dow, it is still worth watching out for. Though over the past 2 or 3 days, you've had this recovery back to 35,500. Thursday session saw that new high for the year, closing basis, that saw the index reach its highest level here since February of 2022. So the recovery in the Dow continues as well. Really seeing very strong gains here from the beginning of July after what's been a fairly indecisive pattern, certainly lagging behind the S&P 500 and the Nasdaq. But the Dow sitting happily where it is at the moment. Next big level to watch becomes 35,860, which, apologies for zooming out again, takes us back to that was the high from November of 2021. We were sort of briefly touched it back again in January, and then beyond that takes us onto the record high at 36,954. It's the S&P and the Nasdaq even closer to their record highs, of course, and it's quite impressive that after 2022, and it still is only August now of 2023, but we're back to discussing if and when US indices might reach record highs again, which is an interesting comment on market psychology in and of itself. But the Dow there showing further strength in trading this morning. And looking to FX markets, as I say, that German PMI reading really putting the cat amongst the pigeons for European markets, and to an extent on the FX front as well. Although with the ECB having delivered that dovish hike last week and having knocked euro-dollar back, perhaps there wasn't much further selling pressure to be seen in this particular currency pair. That's something to watch out for, really. That yes, it has fallen again this morning after losses yesterday, but it hasn't yet gone below, famous last words, the lows of last week around Thursday and Friday. And it's still more or less in an uptrend, both in the short term, if you like, from these late May lows down at 106.30. Also, a much broader uptrend still here. A little bit choppy, certainly, not quite the straight line move we saw right at the end of last year, the beginning of this year, but still making a higher high just 2 or 3 weeks ago. And the pullback here just below 110. You might be seeing some buyers emerge around this level, particularly if it continues to hold above 110 and holds that trendline support. Otherwise, further declines take us on towards 108.50. Maybe if those European PMIs get any worse, that could put further pressure on euro-dollar, because it's certainly the case that we're not seeing much more in the way of ECB hikes at the moment, or certainly until inflation picks up. So that's enough just to take some of the heat out of this currency pair, although for the moment, definitely still in an uptrend. As you can see here, the price pulling back from that recent higher high and still above the 50 and 100-day moving average. So short-term bullish view tends to prevail. The pound also seems to have stemmed its declines for the time being. In a similar vein, we did see it knock back Thursday, slight recovery Friday, a couple of days of losses so far. It is, of course, a Bearian week, so we've got that on Thursday to look out for, so something there to bear in mind potentially, that we could see perhaps a dovish hike from the Bank of England, if we can put it that way. The bank saying we're going to hike rates now, but not again if we can avoid it at the next meeting. So that might just take some heat out of the pound against the dollar as well. But nonetheless, still making reasonable progress to the upside here. A new high just a month ago, same for euro dollar. So the bull's still broadly in charge. It's just they haven't been able to get this one back on an upward path for the time being. So something to watch perhaps if it gets back above 129, I think, in the short term. And then dollar yen, after last week's fun and games from the Bank of Japan, sending what could be argued were slightly mixed messages. from the central bank in Japan there. Dollar yen back on the up. A remarkable recovery here in risk appetite for this one. Down towards 138 middle of July, knocked back there again last week, but then recovering in strong form, really negating any bearish view. So we talked about a death cross of the FTSE 100 of the indices. Here's your golden cross for dollar yen, followed up by, you can see there, dips. Weakness took us back below the 50-day, and then it rallied. So it's interesting how we talk about golden death crosses and how they really reflect what has happened, and that's certainly the case here. If you bought it on the day of the cross, of course, you'd seen it rally, but then drop back again. But it's more of a sign, I think, that the trend has shifted. That's how I tend to view those crosses, rather than of this signal just blindly take a bullish or bearish view. This is the way to perhaps look at it more effectively. So further gains really take us back towards that late June high at 144.93. And so long as we hold above 138, it's very hard to see a more medium-term bearish view beginning to emerge. Finally, commodity prices mixed in early trading, has to be said. Gold once again on the back foot this morning after trying to recover yesterday. So it's moving into a bit of a frustrating consolidation phase, as you can see there. We haven't really gone anywhere since the beginning of July. After that recovery from the lows around 1900, it did try and make a decent punch towards 1990 and so, but then dropped back again, and giving back some of the gains from yesterday's session as well. So it finds itself trapped between still rising 100-day and a declining 50-day moving average. It's probably not a great place to be if you're hoping for it to go higher. I think there's something to bear in mind. For the bulls, you really need to see it back above 1980 to say, actually, the daily close above 1980 to say we have put ourselves back on the front foot here, and we could see a move back to 2000 and higher. That's the thing I think we'd like to see. Although maybe dip buyers did come in on Friday, it might be rewarded if you can go and get the reversal today or tomorrow back above 1980. Alternately, sellers will probably take heart from a close back below 1940, because that then opens the path back towards these lows around 1900 that we saw at the end of June. And then turning to US crude WTI, after that near straight line move from the end of June, it's not surprising to see another bit of weakness creep in today. BP's numbers this morning, though, underlining the fact that perhaps seasonality will support crude oil prices in the medium term, and you've also got, of course, those ongoing production cuts from OPEC, which at least helps to support things. And if there's no recession yet, of course, that still also supports demand. So overall, with the price still looking very happy above the 200-day, we've not seen any kind of reversal. It's still the argument to be made that perhaps we could see it push on towards these April highs at 83.40. Trendline support from June low continues to underpin as well, so watch out for that. If it goes back below 78 and breaks that trend line to the downside, that would be perhaps a short-term negative view. But more importantly, we'd need a reversal probably back below 76 to say, actually, this has been entirely counteracted by a fresh bearish view. So do watch out really in the medium term, I think, for further gains in crude prices, which, if you're looking at the macro picture, might feed into higher inflation readings later in the year, which could upset a few things maybe as we head into Q4. So as I say, the rest of the day dominated by earnings. You've got Chicago PMI 245, but the focus will be on those earnings from the US. And so on that front, you have the likes of Caterpillar, AMD on the tech side, Starbucks, Uber, Merck, and Pfizer really driving things. Then a slight dip tomorrow, and then it's Amazon and Apple, the big ones, plus a host of others on Thursday as well. So that's the key thing really to watch out for. At the moment, we're expecting the Dow to open around about 34,450. Now that's about 100 points down on yesterday's close. There's some slight weakness creeping in after the strong finish to yesterday's session, but perhaps more just caution ahead of those earnings more than anything else. But that's it for me. Thank you for joining us. We will see you again tomorrow at 10:30.